Have you ever pondered over the idea of making your money work for you? Well, today we'll explore an interesting avenue, P2P lending. P2P lending, or peer-to-peer lending, is a fascinating concept that's been gaining traction in the financial world. Imagine being able to invest your money in the form of loans to individuals or small businesses. Sounds intriguing, right? This is exactly what P2P lending is all about. It's an investment form where you, as an investor, lend your money to borrowers through P2P platforms. And the best part? In return for your loan, you receive interest. It's like becoming your own little bank, lending out money and earning interest on it. Let's break it down a little more. First off, P2P stands for peer-to-peer. This means that you're lending directly to your peers, individuals or small businesses, without the need for a traditional financial intermediary like a bank. You may be wondering, how exactly does this work? Well, it's quite simple. You lend your money via online P2P platforms. These platforms connect lenders like yourself with borrowers. It's a win-win situation. Borrowers get access to loans they might not have been able to secure through traditional banks. And you, as a lender, get to earn interest on your loaned money. It's important to note that the interest you earn is not a fixed amount. It can vary based on several factors. But generally, the riskier the loan, the higher the interest rate you can expect to receive. In a nutshell, P2P lending is a unique investment form that allows you to lend money directly to individuals or small businesses through online platforms. It's a way to make your money work for you by earning interest on the money you lend. So, are you intrigued by the concept of P2P lending? Let's delve deeper. Now that you know what P2P lending is, let's understand how it works. The first step in your P2P lending journey is setting up an account on a P2P platform. This is typically a straightforward process, often free of charge, and designed to be user-friendly. Once your account is up and running, you're ready for the next step. The platform will present you with a variety of loans you can invest in. These loans are usually spread across a diverse pool of individuals or small businesses. You're not lending to one person or one business, but rather, your money is divided among various borrowers. This way, you're not putting all your eggs in one basket, which helps to manage risk. Now, here comes the exciting part, choosing the loans you want to invest in. P2P platforms offer a wide range of loans with different interest rates and risk levels. You may find loans with high interest rates but also higher risk, and others with lower rates, but also lower risk. The choice is yours, and it should align with your risk tolerance and investment goals. Once you've made your choices and your money starts to be lent out to borrowers, you'll begin to earn interest. The interest you earn depends on the loan and the associated risk. Higher risk loans typically come with higher interest rates, compensating you for taking on that extra risk. It's important to note that your investment isn't locked away indefinitely. Borrowers make regular repayments, which means you'll see a return on your investment on an ongoing basis. These returns can then be reinvested, allowing you to potentially grow your wealth even further. In essence, P2P lending is a cycle of lending, earning interest, receiving repayments, and reinvesting. It's an active form of investment, putting your money to work, rather than letting it sit idle in a bank account. This is the basic working model of P2P lending. Simple, isn't it? But why should you consider P2P lending? Let's uncover some of its interesting aspects. First and foremost, the potential for high returns is a significant draw for many investors. While traditional savings accounts might offer you a paltry 1% interest rate, P2P lending can deliver returns ranging from 4 to 14% per year. This means that for every $100 you invest, you could earn anywhere from $4 to $14 back annually. That's an impressive boost to your bottom line. Secondly, P2P lending offers an opportunity for diversification. Instead of putting all your eggs in one basket, you can spread your investments across a variety of loans. This can help to mitigate risk and increase the stability of your returns. It's like having a buffet of financial opportunities at your fingertips. You can pick and choose where you want to invest based on your own comfort level and risk tolerance. Lastly, P2P lending serves as a dynamic alternative to traditional savings. Let's face it, letting your money sit idle in a bank account isn't exactly making it work for you. With P2P lending, your money is actively invested, working hard to generate more income for you. It's like employing your dollars as little workers, each one of them hustling to bring you back more money. In a nutshell, P2P lending can provide you with high returns, a diversified investment portfolio, and a more active way to make your money work for you. It's a far cry from the passive approach of a traditional savings account, and for many, that's part of its allure. Of course, like any investment, P2P lending isn't without its risks, but we'll delve into those in the next scene. For now, it's safe to say that the potential benefits of P2P lending make it a compelling prospect for any savvy investor. Compelling reasons to consider P2P lending, wouldn't you agree? Like any investment, P2P lending comes with its own set of risks. Let's discuss those. It's important to keep in mind that the world of investments is not a guaranteed win. The potential for high returns often comes hand in hand with a certain level of risk, and P2P lending is no exception. The most glaring risk associated with P2P lending is the possibility of losing a portion or even all of your investment. The person or business you lend to might default on their loan. In such a case, the amount you are able to recover may be significantly less than what you initially invested. This is why it's crucial to diversify your investments across multiple loans to mitigate the impact of any one loan defaulting. Another risk is platform risk. This pertains to the P2P platform itself. While many platforms have established solid reputations, others may be less reliable or could even fail. If the platform goes under, it could take your invested money with it. To avoid this, it's vital to choose your P2P platform carefully. Research the platform's track record, its security measures, and how it handles loan defaults. Liquidity risk is also something to consider. Unlike some other forms of investment, you can't just sell your loan if you need cash immediately. You may have to wait until the loan is fully repaid, which could take months or even years. Inflation risk, too, can't be ignored. The interest rate you're earning on your loans might seem attractive now, but what happens if inflation rises significantly? Your returns could be wiped out. And finally, there's regulatory risk. The P2P lending industry is still relatively new, and regulations can change. This could impact your investment in unforeseen ways. To navigate these risks, it's important to invest only what you can afford to lose. And always do your homework. Research thoroughly, diversify your investments, and stay informed about changes in the industry. Remember, understanding the risks is just as essential as knowing the benefits. To help you get started, here are some examples of P2P platforms. Let's delve into the diverse world of P2P platforms with a standout example, Iuvo P2P. This platform has been carving a niche for itself in the European market, boasting a rapidly growing user base and impressive annual returns. What makes Iuvo P2P attractive is its high average annual yield of around 9.5%. Moreover, it offers loans that can provide returns of 15% or even higher. This makes it a potentially lucrative choice for those willing to venture into the P2P lending landscape. However, Iuvo P2P is not alone in the P2P arena. The market is populated with a variety of platforms, each with its unique characteristics and return rates. For instance, you might come across platforms that specialize in microloans, catering to small businesses and individuals. On the other hand, some platforms focus on larger loans for established businesses, offering a different risk and reward balance. There are also platforms that provide a varying degree of automation, from those that require manual loan selection to those offering auto-invest features. The latter can be a great option for those who prefer a hands-off approach, allowing the platform to diversify their investments based on predefined criteria. Remember, each platform comes with its own set of terms and conditions. Some may have higher minimum investment amounts, while others may offer shorter or longer loan durations. Therefore, it's crucial to thoroughly research each platform, understand its unique features, and determine if it aligns with your investment goals and risk tolerance. P2P lending is not a one-size-fits-all solution. It's about finding the platform that best fits your financial objectives and comfort with risk. And with a multitude of platforms out there, there's likely a perfect fit for everyone. With these examples, you can start exploring the world of P2P lending.